Hello, welcome to the next of our lecture recaps. This one is on IFRS 5 and IAS 18. IFRS 5, first of all, is assets held for sale and discontinued operations. Looking at assets held for sale firstly. Now, assets held for sale, if we have any that meet the criteria, then we have to show them separately in our statement of financial position. So the criteria that they will have to meet is the PAM 12 criteria. There needs to be a plan to sell them that's not going to change. They need to be available immediately. They need to be actively locating a buyer. It needs to be marketed at a reasonable price. And it needs to be expected to be sold within 12 months of the year end. That's the PAM 12 criteria. All of those criteria must be met at the statement of financial position date. If they are, then we can classify this, and in fact have to classify it, as an asset available for sale. Now, it's not going to be anything other than shown separately on the statement of financial position. And we will measure this, once we've done it, at the lower of the carrying amount, the fair value less cost to sell. And once we've done that, we'll revalue it in the P&L, i.e. if it's impaired, we'll take that to the profit and loss. So we measure at the lower of the carrying amount and the fair value less cost to sell, with that impairment going to the P&L. And when it's classified, we do that immediately. So as soon as it's classified, we do our impairment test and take that to the profit and loss. From then on, we don't depreciate the asset. So from then on, no depreciation on the asset. And we looked at that in illustration 1. We also then in IFRS 5 have discontinued operations. So again, these must meet the PAM 12 criteria. But rather than being an asset, this time we're thinking about a major line of business or a geographical area. There needs to be a coordinated plan that meets the PAM 12 criteria. For example, this could be a subsidiary that's held for resale. Again, we need to show this separately. Discontinued operations, we need to show separately. We'll show a single amount on the income statement for the profit after tax from our discontinued operations, and the post-tax gain or loss if we've measured it to fair value. So again, we need to remeasure it to fair value, gain or loss to the income statement, and we need to show that separately. There'll be a detailed profit and loss account shown separately in a note to the financial statements or separately on the face of the income statement. So we do need to give a detailed profit and loss somewhere in the accounts. So that was IFRS 5. We looked at how to deal with it in illustration 2. We then moved on to IAS 18, which is revenue recognition. And for revenue recognition, first of all, we looked at how to measure revenue. Well, very simply, if it was a cash sale, we would measure it at the immediate proceeds. If it was a credit sale, well then it would be at the anticipated cash that we expected. If the time value was material, we may have to discount it. Now, the key thing in IAS 18 was when to recognise our revenue, and we needed to split this into sale of goods and sale of services. So for the sale of goods, it was where we transferred the risk and rewards of ownership. Now, usually that would be where we deliver the goods to the customer. They then, from that point, take on the risk and rewards of ownership. So we can't maintain any control over the asset that we've sold to them. That means that the transfer of the risk and rewards of ownership is complete. We also need a reliable measure of what we expect to get and a probable flow of economic benefit. Lastly, our costs need to be reliably measured also. For services, well, we still need a reliable measure. We still need a probable flow of economic benefit. This time, we will measure the stage of completion of the contract for services, and we'll recognise by stage of completion the revenue. So for sale of goods, it's transfer and risk of rewards of ownership. For services, we recognise the revenue by the stage of completion of the contract. Others you might need to be aware of: interest will be accrued and time apportioned. Royalties will depend on the contract term for the royalties. And dividends, well, that will be when the right to receive them is established. That is when we will recognise dividend revenue. Just looked at some specifics at the end of this lecture. So we looked at specific areas that might come up in the exam. Deposits, Well, for deposit, if a customer has paid you a deposit in advance, we will recognise the revenue on delivery of the item to the customer rather than when they pay the deposit. So when they pay the deposit, we'll carry that as a liability until we deliver the goods. Goods that we have sold on sale or return, well, we can recognise the revenue when the goods are delivered, but we reduce it by the returns expected based on past experience. Now, one of the key areas you need to be aware of is separating out the contracts. If, for example, we have a package of a computer and software or computer and services, well, we need to separate that out into the goods bit and the services bit. So if we can separate it, we will do. And that will be if we can sell each of them independently and put a fair value on each of them. Then we need to separate it into the goods revenue and the services revenue. Recognise the goods when it's delivered and the services over the stage of completion of the contract. So we did a detailed example of that in illustration 3. So that was a recap of our lecture on IAS 18 and IFRS 5.